Hi, I am Anna. I come from www.ntvforex.com. Better than expected data overwhelmed by record pandemic cases and incoherence among political leaders. http ntvforex.com News ID E51280. 7/17/2020 12:49:47 p.m. Outlook. Again we see the stock market as behaving sometimes despite coronavirus news and sometimes because of it. Yesterday the news was the winner, but before we see economic news triumphing today, keep an eye on that 10-year yield falling to down around a 3-month low. In the US today, we get housing starts and permits, forecast to recover more. Possibly more important is the University of Michigan Consumer Sentiment Index, which retains credibility despite its tiny sample base, possibly because the St. Louis Fed chooses to display it. A gain might be expected. June was 78.1, revised down from 72.3 in May, but expectations lower at 72.3 from 73.1. With its usual sedate language, TradingEconomics.com writes consumer sentiment slipped in the last half of June, although it still recorded its second monthly gain over the April low. While most consumers believe that economic conditions could hardly worsen from the recent shutdown of the national economy, prospective growth in the economy is more closely tied to progress against the coronavirus. And that's the key. As we saw yesterday, okay or better than expected data was overwhelmed by the news of record new pandemic cases and incoherence among political leaders. If the respondents in the Michigan survey are honest, we should see consumer sentiment fall back toward the April low. We're not willing to give up the idea that the bottom is in. The Atlanta Fed GDP Now model continues to show a lesser contraction with every passing report. Yesterday the new number for Q2 is 34.5% after 35.5% on July 9. We get another report today. Another report from the Atlanta Fed is monthly business inflation expectations, unchanged in this week's report at 1.7%. The Atlanta Fed report says current economic environment sales levels and profit margins compared to normal continued to improve over the month, though they remain at historically low levels. Year-over-year unit cost growth decreased slightly to 1.1%, on average. We have been willing to neglect inflation data on the perfectly reasonable assumption that contraction means deflation. Sure enough, the 10-year TIPS yield is all but crashing. See the chart from the St. Louis Fed. But the WSJ points out that while TIPS is falling and hard, the nominal rate is falling by a lot less. The WSJ deduces this suggests investors are both dialing up their inflation expectations and not worrying about any increase in short-term interest rates. The break-even difference between nominal and inflation adjusted has jumped to 1.42% from 1.05% on May 1. That makes the real yield moved from 0.4% to 0.8%, something we haven't seen since 2012 in the aftermath of the 0809 crisis. Here's the central idea taken together: the increase in inflation expectations and decline in real yields both echo and help explain the strong performance of stocks in recent months. A rising break-even rate is typically associated with an improved economic outlook. Falling real yields, meanwhile, can boost the economy by weakening the US dollar and spurring investors to buy riskier assets because inflation is causing them to lose money on their bonds. There's a lot to debate here and more than one interpretation. One that seems likely is that the Fed is on hold indefinitely, exactly as the Bank of Canada said out loud and can be imputed to most other central banks, too. In the absence of this most important of institutional factors, that leaves relative economic growth as the currency level determinant. We continue to imagine that emerging markets and commodity currencies will lead on the growth factor, followed by the Eurozone, in part because Europe tamed the pandemic sooner and better. This is a complicated and twisty path to a forecast of a falling dollar, with the everlasting caveat that a shock can always poke its head out of the shrubbery and drive the urge to safe haven. As for Europe surpassing the US in growth in the immediate future, that worldview is likely to get a punch in the nose by inaction at today's summit, where the top item on the agenda is the $750 Recovery Fund. Of the Frugal Four, The Economist magazine picks out the Netherlands as most opposed to any of it being subsidies, grants and all of it in loan form. This is really quite independent of the other big issue, the 7-year EU budget, but that's pretty messy, too, because unanimity is required there, too. Nobody expects a deal this time, but it seems from the robust euro that some progress is expected, however small. Merkel herself said a second summit will likely be needed. We expect kicking the can more than twice, and if there is no agreement at all on anything, somebody blinks, the euro can have a bad opening on Sunday evening. But it's not in the EU's best interests to display gridlock to the world. There's enough unhappiness about the EU, let alone the EMU already. Commitment to the unity concept requires some kind of progress. Heaven knows we don't want to start talking again about anybody's exit. For the near term, all this implies the commodity currencies and euro recover and go up, while near panic about the US economy fades as the financial markets accept and overlook the pandemic crisis in the US. Just as the stock market is not the economy, the stock market is not a gauge of public welfare. We may not like the stock market going its own way and detached from reality, but it's not exactly new. This is an excerpt from the Rockefeller Morning Briefing, which is far larger, about 10 pages. The briefing has been published every day for over 25 years and represents experienced analysis and insight. The report offers deep background and is not intended to guide FX trading. Rockefeller produces other reports in spot and futures for trading purposes. To get a 2-week trial of the full reports plus trader's advice for only $3.95. Click here. Subscribe our channel to receive the news as soon as possible. Thank you for watching.